Hey everyone, thank you so much for joining our session today. This is going to be exciting. A quick introduction on myself. I'm Mansi Vora, a fellow CFA charter holder and also CFA Boston Society member. I am on the Education and Advisory Council at the CFA Society Boston, bringing fintech and blockchain education to you all. And today I'm super excited to kick off this series, hopefully on decentralized finance. Decentralized finance, if you're not familiar, is an emerging financial primitive based on blockchain technology and cryptocurrencies. And we have here with us Mike Taormina. Hopefully I said that right. Here, who's joining us. He is the head of institutional business at Index Co-op, and he's had an interesting traditional finance background before jumping into the crypto space. He's also a fellow CFA charter holder, and super excited for today's session where we're going to dive into what DeFi is, what it means, what are the risks, some use cases. So without further ado, welcome, Mike. Thank you so much for joining us.
Hey, everyone. And thanks very much for joining and for having me today. It's an honor as a CFA charter holder to be providing content to the organization. And so I really appreciate the Boston Society for inviting me to talk about this emerging theme. I'm going to share my screen. There's always the most risky part of a presentation. Can we get the tech to work? There we go. Okay. So the topic today, understanding decentralized finance, or trying to. Some disclaimers as we jump into material that you're all probably familiar with. This is not financial advice. This is for educational purposes. And I'm going to allude to specific centralized exchanges or protocols or wallets. And so this isn't an endorsement for any particular entity. It's really for educational purposes. And these are some of the most widely used examples. Also a note that this is a very nascent asset class that's highly volatile and can result in a complete loss of funds. And a warning, there will be a lot of jargon. And so I want this to be interactive. If you have any particular questions or you need me to stop, please submit a question and Mansi will have me stop talking. But I was thinking about it. If you take a look at that line there, I think this crowd is particularly well suited to complex financial topics. If you've gone through level 2, I think you can get this. And with that said, I'd love for everyone to walk away from this presentation able to answer the following questions. What is decentralized finance and how does it compare to traditional finance, as we in the space will refer to it as TradFi? What isn't DeFi? What are some of the main use cases and commonly used protocols? What are some of the unique risks that DeFi poses? And ultimately, why does this matter to CFA charter holders and the asset management space at large? Quick background on me. Mansi hit some of these points. I started my career off in traditional finance. I was at JP Morgan in the private bank on the investment strategy team, so high-level asset allocation, and then had my own book of clients for a few years. I then spent the last 10 years in fintech, and most notably co-founding a student loan refinancing platform called Common Bond. But about a year ago, I saw a presentation just like this and got red-pilled, and that's my aim today with all of you, and jumped into researching this space and what's called going down the rabbit hole, and never found myself so passionately trying to understand a new emerging ecosystem and concept. I actually saw and then purchased an index product that you can buy on the blockchain called the DeFi Pulse Index. And it got me exposure to top DeFi governance protocols. And so we'll go into some of them that are actually in that index, but that's what made me interested in learning more about the Index Cooperative, which is actually the entity behind product like those. And so real quick on that, it's effectively a decentralized BlackRock. So we're a decentralized community that is behind index funds that you can buy on the blockchain. The products that we offer today, all in, it's a roughly 240 million in assets under management. That's how this crowd would think about it. We refer to it as total value locked. And we worked with third parties that we call methodologists that come up with the rules for these new crypto products. They give you exposure to themes like decentralized finance, like the metaverse, like the Web3 data economy. And there's just some example tickers there. And we have some really great backers in the space. So with that said, let's jump in. What is this? Decentralized finance is an ecosystem of financial applications built on and enabled by blockchain technology. It's a lot of stuff that this crowd knows very well: lending and borrowing, trading and market making, insurance, asset management, etc. It's just that it's facilitated on the blockchain. Most of the activity happens on a particular blockchain, and that's Ethereum. So most of this presentation will be geared towards the types of protocols you will find there, but the concepts are analogous to some of the other blockchains where this activity is taking place. This chart here makes the distinction between investing in these DeFi protocols and then actually using them, right? So you can buy some of these tokens on Coinbase. That's different from the dollar value of funds actually using these protocols, actually doing the lending and borrowing, actually providing liquidity on decentralized exchanges. And so that's what this chart is actually showing: the total value locked, the USD equivalent of funds being used in the space. 2 years ago, it was less than $1 billion. And as you can see, by some measures, it's over 85 billion. There's another source called DeFi Llama. I'm not sure their methodology, but they're showing it at 127. And what you can see is Ethereum is by far and away the queen bee in the space. A lot of the other blockchains on this list are actually copies of Ethereum that have been tweaked, like, for example, Avalanche or Polygon. So they're what's called EVM, or Ethereum Virtual Machine compatible. What you can see, again, Ethereum is dominating, but there are some others that are competitive to Ethereum. One blockchain you're not going to see on this list is Bitcoin. And much of this presentation won't actually go into Bitcoin at all, save some history of how we got to decentralized finance. And I'll explain why that is. But what makes DeFi different from traditional finance? The first thing is it is decentralized, right? So because it is on a blockchain, it is borderless. It can be accessed from anywhere. It is also permissionless. And so if you see this image on the right, this is one of the protocols called Compound. You click on a button that says connect your wallet, and so long as you have an Ethereum wallet, no matter where you are in the world, you can connect to Compound. You don't need to fill out any forms or paperwork. It's open to anybody, and that makes it accessible. It's trustless because it's based on blockchain technology. So if a transaction happens, it really did happen, right? That's the beauty of working with a blockchain like Ethereum. It's trustless. The protocols themselves are open sourced. So if you go to any one of the sites, you can access the GitHub repository where they keep the code. And you can use that code if you wish. And that makes these protocols interoperable or composable. You know, there's this concept of them as money Legos. You can take one of the protocols and build on top of it because all this information is out in the open. That makes it very scalable as well. And I think one of the defining things is the self-custody aspect. So on my phone is where my assets effectively live. I don't have to go to a centralized institution in order to access it. But that also carries some risks, and we'll get into that. The byproduct at the end of the day is we have very scalable, secure, accessible, and cost-effective financial platforms. So that's what it is. Let's talk about what is not DeFi. There's a lot of trading, there's a lot of lending and borrowing that goes on in DeFi, but there are also centralized institutions that are facilitating this when it comes to crypto. The Coinbases, Geminis of the world for centralized exchanges. You've probably heard of BlockFi, which facilitates crypto lending. Because there is a centralized institution behind this activity, it is not DeFi. And going back to my point earlier about using versus investing, if you purchased DeFi governance tokens on Coinbase, which you can, that doesn't mean that you're participating in DeFi. DeFi specifically means going into the ecosystem. But that's why those centralized exchanges are really important. They operate as on-ramps into this ecosystem. And so you can't move funds easily directly from your bank into the DeFi ecosystem. You usually need to have an intermediary step with a crypto exchange. And so opening up a Coinbase account and funding it from your traditional bank account is typically step one. And from there, you can move your funds onto a crypto wallet, typically a mobile app. There are also hardware wallets like Ledger that provide an extra level of security. Highly recommend using one like that. There are a few different providers, but the common crypto wallets you'll hear are MetaMask, which has over 20 million users. Coinbase, confusingly, has a Coinbase wallet, but that's different from the exchange account that most people know and love.
Mike, quick question.
Yeah.
So these exchanges that you mentioned, it's similar. Is it similar to opening an account with, say, a Fidelity, or like in the traditional world? How's that experience? These are crypto exchanges, but what is the user experience like?
That's exactly right. It's a KYC AML process if you're in the United States. So Gemini, Coinbase, all of these actually. You can open up an account in the US, but you have to go through a traditional account opening process that comes with pretty stringent KYC AML, as opposed to the crypto wallet experience where if funds go onto there is no KYC or AML. People who are doing it within the US, because they've gone through the crypto exchange account, everything is connected. So at the end of the day, you're not getting away with anything there. It's still very, very much trackable. But that's one of the big differences.
Thank you.
It probably makes sense to take a second high level, quick history lesson. So this all does go back to Bitcoin. Bitcoin emerges in 2009 and is really an archetype for what blockchain technology can do. And so Bitcoin, simply put, is a payment system that tracks which addresses hold which amounts of Bitcoin. It does this really, really well. So much so that it's virtually unhackable. It's never been hacked since launched in 2009. It's trustless, go back to some of the same adjectives, but that's really all that it does. And following Bitcoin, you saw some special use case blockchains emerge, like, for example, Namecoin, right? That was getting at decentralized domain services. And so these different use cases would pop up, and each time they would need to think through a different infrastructure for enabling it. And that was the opportunity for Vitalik and his co-founders at Ethereum in creating a general purpose blockchain, something that can enable lots of different use cases and do so via smart contracts. And so that flexibility allowed for an infrastructure that enabled ultimately decentralized finance. But as people were waking up to the possibilities of Ethereum and Bitcoin, the hype got ahead of reality. Okay, so in 2017, there was a massive run up, and that was followed by a devastating crash for those who were in the space. An 84% drawdown in the case of Bitcoin. And the real reason is analogous to the dot-com bubble in the late 90s. There really weren't solid use cases. But within or during crypto winter, the teams that stuck around and continued to build, what came of those efforts, right, is the emergence of actual use cases. And so principally that would be decentralized finance and NFTs. And that really shot off in 2020. That's what's known as DeFi summer. And it really is a Cambrian explosion in all the variety and nuance and innovation. This really kicked off. I said it was less than $1 billion 2 years ago today, and then just exploded. One of the protocols launched a governance token. This is Compound. And it served as, they would provide incentives for users, providers of capital to
Mike,
bring.
sorry. What is a
Yes.
governance token? You
Very
mentioned
good, very
that
good. So Index Cooperative, for example, has a governance token. It's kind of like equity in some ways. It's an ownership in the project, and it's a way to vote on key decisions for that project. So in the case of Compound votes on which assets should be listed for lending and borrowing. And so based on who has comp tokens, they can vote on those key decisions. Yeah, thank you. And so they launched their comp token in spring of 2020 and started incentivizing capital to both lend and borrow on the platform. So lots and lots of capital started to come in, and people saw this user acquisition playbook work pretty well. And so you saw an explosion where a lot of other projects did the same thing. They would launch a token, and then they would use incentives to attract capital to their application. This concept, if you're a user, is known as yield farming. So finding opportunities where you can generate yield on your assets. From the perspective of the protocol that's looking to have a lot of activity take place on its platform, this is known as liquidity mining, but they're really two sides of the same coin. And one of the other key factors in this DeFi summer explosion is the role of stablecoins. And you can see on this chart on the right, July 2020 is really when things started to take off. And these are some of the top stablecoin assets in the world. A stablecoin, simply put, aims to maintain a peg to another asset. There are four main kinds. The most popular known, I would say, are the fiat-backed stablecoins. So this is one-to-one, oftentimes with the US dollar. So this is USDC, this is Tether, this is Paxos. They all have one-for-one stablecoins where there is a reserve holding the actual dollars. And then as those dollars go in, these stablecoin tokens are created. There are also crypto-backed stablecoins. And so DAI, for example, has USDC as one of the reserve assets that is behind it. There are also, it doesn't have to be a dollar. There are also versions that are tied to crypto assets. So I said Bitcoin, there's not really much going on as it relates to DeFi, but you can take Bitcoin and wrap it into WBTC, which is a stable coin pegged to Bitcoin, and use that asset within the Ethereum ecosystem. It effectively turns Bitcoin into the Ethereum standard token so that you can use it productively. There's also algorithmic stablecoins that seek to use incentives and not reserve backings in order to keep a peg. And then finally, commodity backed, but these are lesser used. So this is like tying it to the price of gold. The key uses in DeFi, this is a way to earn yield in a stable way, so devoid of crypto volatility. It also facilitates leverage. And again, in the case of something like Bitcoin, it allows you to take assets from outside of the ecosystem and use them productively within it. So let's dig into some of the main use cases and protocols. Keynote, and I just walked right into it. Protocol equals platform equals project. I use them interchangeably. They're all the same. What you'll notice on the left with this bucketing, and this is just kind of the high level examples for each of these types. This is the same stuff that you would find in traditional finance: trading, lending, asset management, derivatives, that's synthetic assets, that's options markets, as well as insurance. Now, while there are different types, 80% more is really focused in lending and in trading. You also see the emergence, as the space has evolved, of aggregators. Yield aggregators, exchange aggregators, they are platforms that look across the individual projects to optimize for the highest yield or the best execution. So this is kind of a natural evolution of this of this ecosystem. So if you want to trade, it's probably better for you to go to one of the aggregators to get the best execution possible. And then they look to the individual protocols. An example of that would be 1inch or Matcha for trading. What we're going to do is actually go through 3 DeFi protocols. It's the best way. It's a better way than me just speaking theoretically about this to actually see it. The absolute best way is following this presentation for you to go and do it yourself. No better way to learn than actually using it. But screenshots in the interim will hopefully make some of this make more sense. The first example is a lending protocol called Aave. And I've called out some particular things to look to in this screenshot. The first one is on the top right. It usually would say connect wallet there. And so that's where what I get back to with it'll show you a QR code and you simply wave your mobile phone, your crypto wallet over that QR code, and you are immediately connected to this site. You have effectively opened your account. Second thing to point out is this platform in particular is really growing. Overall, it has over 20 billion in assets. In this particular instance of Aave, there is 12. This is what it exists on Ethereum mainnet. You see point number 3, a little over to the right, Aave exists on Ethereum. It exists on alternative chains like Polygon and on Avalanche. And so all in, if you look across those 4, it's over 20 billion in assets. Going down to point number 4. So these are, I sorted this by the cryptocurrencies that have the most value staked into this platform or lent into this platform. So Ethereum is number 1. There's over $4.2 billion of Ethereum on the Aave platform. You also see Bitcoin down there. So wrapped Bitcoin, as I said before, that's the Ethereum representation of Bitcoin. That's a way for people who have Bitcoin to use it for collateral, to earn interest, etc. And then the other 3 big assets up here are USDC, DAI, and Tether. Okay, those are all 3 stable coins. You can see a common trade is to stake Ethereum to a platform like this, to borrow USDC. And you see if you want to do that today, you're going to be paying an interest rate of 3.12%. And then purchase something else, purchase more Ethereum, take USDC out of the system, buy a car, right? So use your Ethereum to then make a real world purchase or to create leverage or to generate yield. That's what this platform allows. And then the final point, as you can see towards the right, there's both what you earn if you stake your assets. So that's the deposit APY. It's going to be very low for Ethereum because there's 4.2 billion that's being lent out, but only 127 million that's actually been borrowed. And so that's a very low utilization. That results in a very low yield. The reverse is true for something like DAI, where of the 1.4 billion, 1 billion has been borrowed. And so there is yield that is being earned from those who are borrowing, and that is accruing to the benefit of the DAI token holders. And then the final thing is it's possible to have a fixed rate in this space. This group knows fixed and floating swaps, but most of the borrowing that takes place is variable. I zoomed in on USDC, and again, following the numbers in order, there's been 3 billion that has been staked to Aave in USDC. Of that, 2 billion has been borrowed. A little less than 1 billion remains. That imputes a utilization of about 69% of the USDC. And there's an algorithm that then spits out what the deposit rate will be, what is going to be earned by that 3 billion of USDC holders, and then what is going to be charged to anyone taking a loan out in this particular asset. There's LTV, just like in traditional finance. So they'll let you borrow up to an LTV of 82.5%. But if it gets to 85%, you'll be liquidated automatically by the protocol to protect the depositors. There's no FDIC. You are looking instead to the software to protect you. And if that happens, there's a liquidation penalty of 4%. So you can start to see how Aave as a protocol generates cash. That's lending. The next concept is decentralized exchanges. So as opposed to an order book, which is what we would commonly think of, New York Stock Exchange, Coinbase itself, these centralized entities use order books to match buyers and sellers. And there's the involvement of market makers. A decentralized exchange is also known as an automated market maker and doesn't require an order book through its architecture at all. There's two types of users. I think I've made some sense of it in this diagram below. Imagine if you had two assets, we'll call them A and B, that you're holding in your crypto wallet, and they're just sitting there. You're a big believer in them. A decentralized exchange allows you to put those assets to work while you hold them. So imagine many different people who have asset A and B all contributing different amounts into a pool. They are all known as liquidity providers. Someone who has asset A but wants asset B, who wants to trade, i.e., can come to a decentralized exchange and engage with that pool, paying a fee along the way in order to exchange A for B. The fee is kept in the pool and it accrues to all of the providers of liquidity based on their pro rata participation. So if someone provides 10% of the liquidity to this pool, they're going to earn a fee of 3 basis points on any trades that take place. These decentralized exchanges work by following a mathematical equation that keeps the pool in equilibrium between asset A and B. And so in our example, if someone trades A for B, there's more A in the pool than there is of asset B. And so the pool is no longer in equilibrium. Over time, as this happens, A will start to, within the pool, trade at a discount versus what it would be offered outside of the pool on, say, a centralized exchange. And so what's pretty interesting is that creates an arbitrage opportunity for either a human or a bot to come in and take advantage of that, thus bringing the pool automatically back into equilibrium. So these players within the construct are incentivized to keep the pool in equilibrium, to keep the pricing where it should be. That's to the benefit of both liquidity providers and anyone who wants to trade using this system. I will give you an example. It's not the biggest one, it's one of the biggest. The biggest one is called Uniswap, but it is actually even more complex than what I just said. So we're gonna stick to SushiSwap because it is both an easier version to comprehend, and it's also typical of how a lot of the exchanges work across the broad DeFi ecosystem. Uniswap is kind of in its own category. So as I was explaining, in SushiSwap, you earn as a liquidity provider 25 basis points of all the trades that take place. You pick 2 assets that you own that you want to provide into the pool. So in this case, I have, okay, you're going to provide 1 token of Ethereum, which means you'll also have to put in 674 tokens of sushi. It's hard to make out, but number 3 down there shows you that's going to represent 0.02% of the overall pool. It's a really big pool. The 4th thing is that in order to deploy your assets, you actually need to approve it. So this is a common concept. You need to approve spend within the wallet before something like this will happen. And then the 5th thing to call out is that there is an analytics suite for all of these decentralized exchanges that shows you how big is the pool, how much trading is taking place in the pool. And when you look at the fees as a numerator over the pool as a denominator, you can back out what the annualized APY would be. So what would a liquidity provider earn for providing liquidity to this pool? In the case of Sushi and Ethereum, it's a little under 8%. Taking a breath. The third protocol that I wanted to go over is an asset management protocol called SET. Now, this is actually one of the partners of Index Cooperative. And what they do is allow anyone to come to their platform and take the Ethereum standard tokens, which are known as ERC20. All the tokens in Ethereum all follow this standard, to take multiple tokens and to wrap them into one, effectively creating a portfolio. The DeFi Pulse Index is an example of that. It aims to provide cost-effective one-click exposure to many of these DeFi, decentralized finance protocols. So what we went over before, the governance tokens are what's in this basket. And it's different from what you'd expect in traditional finance. So even if, BlackRock, Grayscale, Bitwise, that they come up with crypto-focused products, something like this differs from those traditional structures, ETFs, limited partnership funds, in some very meaningful ways. One, it trades 24/7. News comes out about China on a Saturday, you can get out ASAP. Two, self-custodied. So you really own those assets at the end of the day, right? The account is not owned by, say, Coinbase. Those assets exist in your wallet. Three, it's redeemable. Imagine if you could take a SPY share and redeem it for the 500 constituents of the S&P 500. It'd be very difficult. You can actually do that in the space. If you wanted to, you could take a DPI token and exchange it for its 14 underlying constituents. And then finally, and I would think most interestingly, it can be used as collateral. So going back to Aave, which we went through before, DPI is one of the assets that can be used as collateral on Aave. So you can yield farm, you can create leverage, you can also do some market neutral long short strategies. Again, something I think would be interesting to this audience. So if you want to over index or under index on one of the 14 components, you can hedge the market exposure with DPI. On this slide, I just show what that interface on SET looks like, and the fact that you can mint and redeem into the underlying constituents. That's what this screenshot on the right shows. So if I was looking to redeem 100 units of DPI, I would be getting the full list of its constituents, which I think is a pretty interesting distinction versus traditional finance. So those are three examples. I hope we all made it. I want to go into some of the key risks that are different in decentralized finance from what we're all used to. First one is smart contract risk. And some of these headlines to the right illustrate just how devastating it can be. And it just refers to the human error of not writing the software in such a way to avoid hacks and exploits. So a lot goes into making these smart contracts robust. It's not perfect, and there have been exploits, especially in these early days. Second big risk is regulatory. We just don't know, because there hasn't been a lot of clarity from regulators, how this space will be treated. And so that poses a risk to anyone looking to engage or invest in there. The third risk is user risk. And this is the risk, not that you get exploited, but more a self-exploit. From personal experience, I actually made a user risk, or I made a transaction on Friday that was just a complete error, but it was all on me. And it just speaks to how the user experience in this space is still very early on, and it's possible to make mistakes that are then irreversible. Fourth thing is seed phrase risk. When you get a crypto wallet, you are given 12 words, which are cryptographically configured and serve as your private key. If anyone gets access to those 12 words, they have access to your funds. So keeping that seed phrase to yourself, nice and secure, is very important. And the final risk I'd call out is decentralization risk. There is no customer support. There is no centralized entity. I mean, there might be some customer support, but it's just not what we think about when we think about the traditional financial ecosystem. There's no FDIC. It is, in many ways, the Wild West. It's both the pro and I think the con. Why does this matter? I think the number one reason for CFA charter holders or asset management in general is your clients are asking about this. This is becoming, it already is, an alternative asset class. There was some recent research on this. 94% of advisors have been asked about crypto to some extent, and it's not just Bitcoin and Ethereum anymore. And so you need to know the high levels of this ecosystem to be able to talk about it, just like any asset class. I believe that understanding this material is a major competitive advantage. And what you're seeing, and this comes from that same Bitwise report, 47% of advisors are themselves deploying personal funds into crypto, and increasingly, I don't know what the percentage is to DeFi, but it is ahead of their clients. And so my takeaway here is it's probably looking for regulatory clarity, but it's also an effort to better understand how this works before exposing their clients to it. The third call out is that these are cash generating financial businesses. Look to the right. This is a website you can check out that shows the fees across all the blockchains. Ethereum is, again, number one. And you see anything in white, those are competing blockchains. Bitcoin is listed there. But what's in pink, those are all DeFi applications. So the number two application, one of the decentralized exchanges, Uniswap, is actually kicking off almost $3 million on a daily basis. If there was ever a crowd that would be interested in analyzing business models like that, it is this crowd. And so some trends to watch as we go through 2022, there will be increased institutional adoption, just naturally because that's the momentum, but also because there have been AML/KYC compliant instances of some of these protocols. Aave, for example, has launched Aave Arc, which is a whitelisted version of its platform. And so institutions now have a compliant way to participate in DeFi. It's not just institutions. 2022 is going to see better opportunities for retail as well. One of the criticisms of Ethereum is that it's very expensive. Every time you engage with the blockchain, you have to pay a fee in Ethereum, and it's expensive. Scaling solutions known as layer twos are effectively side ecosystems that benefit from the security of Ethereum, but don't come with the same costs. So you're able to trade for pennies instead of $120 for a transaction, for example. That's going to bring a lot more retail into the ecosystem in 2022. You'll continue to see DeFi protocols innovate and kind of push the envelope. So exploration to uncollateralized lending models, for example. But the flip side of that, I think things will get more user-friendly. And that's where fintech has a role. Fintech had the promise of financial revolution, but I'd argue that's DeFi is making good on that promise, at least from a financial rail standpoint. But actually engaging with these applications, I think fintech has an opportunity to help DeFi along and make it more user-friendly. And then finally, a really big event that's supposed to happen this year is Ethereum transitioning to proof of stake off of proof of work. This has environmental implications. And I mean, if it happens like expected, I think it's very bullish for Ethereum and crypto in general. And so if you're looking to learn more about this, I would say go to DeFi Pulse or DeFi Llama. These are two really great generalist sites that show leaderboards, which applications are being used more than others. If you want to dive into a specific project, one of the amazing things is that you can go to the website and they all have the same common resources. You can access the GitHub to see their source code. You can go to Discord to talk to the team. They all have Twitter accounts. And so I listed some examples for Index Cooperative. And then if you want to follow up with me, I've listed my Twitter and my email. And with that, I'd like to turn it over to the audience and answer any questions that you have.
Thank you so much, Mike. That was really interesting, especially going through some of the use cases. There are some questions that have come throughout the session that I will pass it along, but please definitely feel free to ask questions in the chat. We will try to get to as many as we can. The first question for you, Mike, how liquid is DeFi currently in terms of being able to make large trades? Is it just catering retail investors, or can it also cater the scale that institutional investors need?
Yeah, good question. It depends on the asset, of course. So even when I think about our products, right, the DeFi Pulse Index is the most liquid. Why is it the most liquid? Because we've incentivized liquidity pools on Uniswap. It goes back to some of the concepts we've been going through here, incentivizing liquidity to a specific liquidity pool, ensuring that there's depth to the token. If there's depth to the token, more users will want to participate. And so it's this nice self-fulfilling cycle. There's also the ability to do exchange issuances for our product. So you can deposit Ethereum, and then we have a smart contract that will go out and work a large order. So if someone wants to spend more than $300,000, for example, we would advise them to work with, or to use an exchange issuance contract. There's also market makers that are in this ecosystem helping to make it increasingly liquid. So we have a partnership with Wintermute, for example, and end users can they can do OTC trades directly with Wintermute, but Wintermute is also then providing assets across to various liquidity pools.
Yeah, and I think there are OTC desks across different assets, especially the Bitcoin ecosystem is much more mature. Bitcoin and Ethereum, I would say, for OTC trading. There's a question around how are regulators reacting to DeFi? I think, Mike, you already kind of alluded to some of this. And then the sub question is there any KYC AML process?
I think that the protocols are appropriately looking down the field at what might come. And so you saw Uniswap proactively delist assets from its interface. This is probably 6 to 8 months ago. That would be problematic for US regulators. Aave launching a KYC AML compliant version of its site, which allows for its kind of core instance, it to continue to be truly decentralized, but then also creating this sandbox that lets entities that where they are regulated, they need it to be KYC compliant, and then they actually can use DeFi. And so it's great that we're seeing more of that come to market. And then in general, as it relates to regulation, I think the entire industry, believe it or not, wants regulation, wants clarity. And when it comes, the knee-jerk reaction is probably going to be that the market sells off. But I think in the medium to long term, having that clarity, even if it means you can't do X, because a protocol, let's say the SEC came out and said, you can't do this in the US. US people can't participate. The byproduct of that could be the protocols ring fence the US out and continue on, right? So just having clarity will allow people to make decisions to ultimately abide by the rules or exclude entire areas if that's what they choose to do.
Which, in my opinion, would be unfortunate for the US if that happens. But hopefully, at least the conversations that I've seen with regulators, they are more open and still kind of trying to understand the different protocols before jumping in with any strict regulations. So I'm hopeful.
I'll add one thing. I don't know if anyone knows Ryan Selkis over at Masari, but in the wake of what looked to be some pretty onerous regulation back in September, October, there's been a real response from the industry to basically make clear that they want to work with the regulators on figuring this stuff out, and hope that it's more of a productive conversation than something that's handed down or an application of 90-year-old regulation when you think back to the 34 Act and stuff like that.
Yeah, there's another question around stable coins. I know Tether especially, sometimes gets questioned around the reserves and whether it's fully backed. But generally, if stable coins fail, what is the risk to the overall DeFi ecosystem?
Yeah, I mean, if there is questions around what's actually behind the stable coins, or just in general, onerous regulation comes, it could look like a bank run as everyone tries to get out. Tether has been in the news for years about whether what is backing the assets is actually safe enough, right? So this is an area where I think we're pretty sure to see some regulation. I mean, in the last few days, I know there's been hearings on it. This is going to be something that's welcome just because of how important stable coins are to this ecosystem thriving.
Yeah, and I think the only thing I would add there is because it's not just a single stable coin and also not a single way of issuing stable coin, like Mike, you mentioned, there are 4 different types. There's a lot of diversification. So a systemic risk in, say, a fiat-backed stable coin doesn't necessarily affect crypto-backed stablecoin. So, a risk of that nature where all stablecoins fail seems less probable. Then going to the liquidity pool slide, Mike, if you want to pull that up. What happens when a large participant wants to leave a liquidity pool? How does it affect the assets in that pool?
So if there's a pullback in liquidity, the byproduct is any subsequent trades are going to have what's known as slippage, or they'll have more slippage. So, you have a $10 million pool and then $9 million gets pulled out. Trying to execute a $10,000 trade is going to have a lot more slippage than it did prior to the liquidity leaving the space. It is an opportunity for new liquidity providers to perhaps earn more yield. So it's not completely negative, but I think for the traders, obviously, as more liquidity is pulled out, that's going to be a bad thing.
Where do DAOs fit in all this, Mike? I know index co-op is a DAO. So how do DAOs and DeFi kind of interrelate?
Oh my gosh, we could do a whole topic just on that. So a DAO is a new form of organization. It stands for Decentralized Autonomous Organization. And it really just means a group of people who have unified around some common idea and use a governance token to coordinate, to vote on various decisions that come up. So in the case of Index Cooperative, we have a token, it's called Index, simple. And when a new product, for example, comes to a vote, right? So someone could come to our governance forum and propose that we do an index of layer 2 tokens. Just go with me. And we will inspect that proposal, and then we'll hold a vote. And based on, if there's quorum rules, but assume we hit quorum and the majority of the token holders are in support of that product, it will be approved and then slotted for development. And so that's how we use, that's an example of a DAO using its governance system. We talk about Aave. So the assets that are listed here have all been voted on by their community, and they use their Aave tokens in order to do so. So, DPI, for example, went up for a vote and was subsequently voted in. They also vote on risk parameters, right? So certain assets here have lower LTVs than others. So those different aspects are actually agreed upon by the community, and those communities are also referred to as DAOs.
Yeah, I agree. We can do a whole session on
whole
that.
thing.
Maybe we'll do one. There's another question. What is the underlying demand or use for these projects? I think, you mentioned they lend themselves to trading and other financial market activity, but are they just trading vehicles, or do they have an underlying demand?
So I think I know where that question's going. What are we really doing here, right? Is this just crypto for crypto's sake? What is really the utility? I'm so glad that question was asked, because I've thought about this too, especially when I first came into looking at all of this. You're staking crypto to earn yield in crypto, or perhaps borrow more crypto to buy more crypto. And are we just pushing tokens around? It does feel that way. Same goes with the decentralized exchanges. So I'm providing these tokens as a liquidity provider so that other people can trade their tokens. And so, you do take a step back and go, what's really going on here? But if you make one tweak to that thinking and appreciate the likelihood that we're moving increasingly to a world that is more and more tokenized, and you realize these are the rails that will facilitate that commerce, then this makes sense. Right, so lending and borrowing will take place on Aave. Will the assets look like this? No, that's going to evolve. Maker is an example of a lending platform that is exploring real world assets, tokenizing real world assets and putting them onto their platform. So just imagine where this can go in 10 years. We're effectively in a phase where we're testing out these rails and innovating with these rails, but what they can facilitate if we move to a world where it's just increasingly tokenized, that commerce will live here.
Yeah, we're still very early in terms of this technology. Yeah. There's another question, which I think a lot is on a lot of CFA members' mind. It seems like there's a long way out for advisors to become as educated as you are, Mike, or have all of the expertise around this specific technology. How should they engage with clients in this conversation if they only know 0.001% of how crypto works?
I mean, just coming to a presentation like this, you've already leapfrogged so many folks. Like, this is the best thing to do, is just to go to more presentations like this and get the theoretical content. And then, as I said earlier, actually going in and using it yourself. So if you spend some funds, put them in a DeFi or in a crypto wallet, participate in DeFi, think of it less as an investment of financial capital and more an investment in your career to attain that competitive advantage.
Yeah, I love that. I think all of us in the crypto space learn by doing, by actually trying out some of these protocols. And I think hopefully we get to a stage where they are mature enough. But at this stage, we definitely have a lot more hand-holding to be done. What are the taxation issues surrounding these transactions?
So there are two things. First is following that other comment. There are platforms like OnRamp or Height Zero that are helping advisors to manage their clients' assets. So just an FYI on that. And then we would go into taxation. So the thing about blockchain technology is that all the information is there. It just needs to be collected and analyzed. So there are platforms, Token Tax is one of them, where you can connect all of your accounts, either decentralized exchange accounts like a Coinbase or your MetaMask wallet, and have a holistic view of all the trades that have taken place, and it analyzes that. I mean, beyond that, what, a specific tax question is probably not my jurisdiction, but the idea of this all being tracked, captured, and just incorporated into your tax filing, that is absolutely underway.
Yeah, and there are tools, like you mentioned, Token Tax, that help you with just your crypto taxes, but essentially anytime you convert fiat to crypto, or crypto to crypto, or crypto to fiat, that's a tax implication there, where you have to pay tax on the profit or increase in price, and hopefully, the other way around, you can deduct taxes if it's a loss.
There's a lot of analogous concepts to foreign exchange.
Yeah. There was another question, and this is just around Bitcoin, Mike, so feel free to take it or leave it. But it's the question is Bitcoin, the industry says Bitcoin cannot be hacked and never has been. Can you explain what that means in terms of unhackable? Just wondering if there are ways to hack it that hasn't been figured out yet.
Well, if there are, I do not know them, but I'll explain why it hasn't been hacked as far as we can all tell yet for today. So think of Bitcoin as this payment system that is comprised of tons of individual computers that are decentralized globally. In order to hack something, you would need to manipulate the information. You would need to have access to over 50% of all the individual clients or computers in order to hack Bitcoin. Because there are so many nodes, it's not financially feasible to actually do that. Even if you tried, it's a massive financial cost, and it's very unlikely to work. So the strength of the system is the fact that it's so decentralized and it's incentivized. That's what the mining rewards do. It's incentivized to only get stronger and stronger and bigger and bigger. Same goes for Ethereum and other blockchains. They're incentivized to be decentralized. The more decentralized they are, the more robust, the more unhackable they are. And so Bitcoin is the most decentralized of all.
Yeah, and I think it goes back to the point where it's not a single database that you can hack and access all of the Bitcoins that exist. Each individual can have control and manage their own, Mike, you mentioned seed phrase or like a password that essentially allows you to access and manage your own Bitcoin. So it kind of disperses that risk from a centralized to a decentralized nature. And I think we are at time, but Mike, if anyone wants to reach out to you or, specifically they want to, I know there was someone who asked if they can access these slides. What's the best way?
So I have my info here if anyone wants to reach out to me directly, and then, yeah, we could probably share these slides. So look for that in a follow-up. And I really appreciate everyone's time. I know this is confusing stuff. I always say you need to have it wash over you many times before, this at least how it was for me, to really absorb it. I encourage people to go and do it themselves. And if you have any questions, hit me up. Thanks so much.
Thank you so much, Mike, for joining us today and giving your time and just walking through this incredible presentation. Really appreciate it. And thank you everyone for joining us today.
Thank you.
Bye.